Hi, everybody. Welcome to this week's Middle Class Investor. This is Seth Martin. It is Saturday evening of March 17th, about 9:15. We're looking at the S&P 500 since the February 16th low. And you can see we kind of started in the bottom part of this channel and we've moved up and we're kind of in this part of the channel. Now, this is on log scale. If you put it on arithmetic scale, we're actually... Here's the channel right here. We're actually above the channel. So, I don't know, I'm putting on a log scale. As you can see, we had a week that was down last week. I think the Dow was down about 500 points, and the S&P was down. I'm not sure, but it was down. It was down as well. So. You know, there's, as you can see, we're right in the middle here of this big down, and then we've had this choppy up. Now, normally, this is you know, this would be an area of concern, and I would say until we make a new high, it's an area of concern. These 2 weeks right here were substantial. We'll look at volatility in a second, but when you have this kind of sell-off in the market and a spike in volatility that we had, it's really unusual for this to be just a pullback in a continuation of a bull market. So even if you go back, if we go back and look at the volatility back here on in February of 2016, let's just pull the volatility up and look real quick. See here in 2016, the volatility got up to about 32 in the second move down. So let me go back. Let me go back. So you can see here we had a move down, and then a move up, and then another move down, which made a lower low. But if you notice, the volatility in this move down reduced. So let's see, this low was on the week of August 24th, 2015. So remember that, August 24th. And this low was the week of February 8th. So let's go back and look at the volatility. And what you're going to see is the volatility contracted. So this should be the week of, August 24th, 2015. We peaked up here at 52.5. But then the week of February 8th, where's February 8th? Right here. So let's just mark these right quick. So this is the first move down in August of 2015, and then this is the second move down in February of 2016. And you see the volatility made a lower low. So I think what we have to see here, let's go back to the chart, is if we make a lower low and volatility is higher than this, then we got trouble. Look out below. If we make a higher high and volatility continues to contract, then we've got more upside. I think that's probably the easiest way to think about it. But right now we're right in the middle. And I'll share some stuff with you from Elliott Wave. They're saying this is a wave 2. So this was a wave 1 down. This choppiness is a wave 2 up. And there's a couple different options here. I'll show you a couple of those. We can look at it. But if this is a wave 2 down, the next move down, I just want to give you an idea of what we could potentially be seeing. Because it can be substantial. The next move down could take us below 2,000 on the S&P 500. So we're talking about a 750 point drop, and then eventually it would take us to this blue box down here. This is the previous fourth wave low. So unless it makes a new high, and then this would be the previous fourth wave low. So, but I think that's unlikely just because I think the kind of pullback that this bear market is going to deliver first is going to be the kind of pullback that's not just a correction. It's more of a crash, to kind of wipe out the last 2 years worth of gains. So I'm thinking the odds are that we probably pull back harder and catch everybody off guard. If all we did was pull down to here and then rally up and then sell off, I don't think that would catch as many people off guard. And like I've said in here before, the design of the market is to fool most of the people most of the time. So you'll hear people say that from time to time, and I think it's true. I think the market is really because it works against psychology. The fear and greed aspects of the market. I think it tends to get people all twisted about right at the wrong time. So that's let's go back to volatility. So maybe I'll tag these. I'll label these. This is wave A down, wave A of 4, and this was wave C of 4. I'll do that after the recording tonight, just to kind of remember that. Let's look at yields. Let's look at the short-term yield. Of course, the Fed is, I think it's Wednesday, they're going to make their pronouncement. And according to this chart, let me take it off log. According to this chart, the Fed will be raising rates. There's just no doubt about it. And even if they don't, these yields are going to continue to go up. So, but I think the odds are, because the Fed follows rates, that they'll probably be raising rates this Wednesday. So look for that. Probably be a lot of volatility, a lot of swings in the market on that kind of news. Usually is, especially with one here. They skipped a rate hike last time, and I think they got criticized for it. Because the market kept rallying up, and so this time they'll probably go ahead and raise rates. They can't let this get too far ahead of them, because it'll undermine their credibility. And I think they're more concerned about their credibility than they are the actual market performance, or how bad the market gets. Let's look at some of these other countries. I'd pointed out last time and a couple times before that these moves are very similar looking to our market, and so I think that also is where I think and I love Peter Schiff, but I think I think ultimately he's going to be right. And if you're not familiar with Peter Schiff, he's saying that we're going to have a dollar crisis. But I think before we have the dollar crisis, we're going to have massive deflation. And that's going to be bullish for the dollar. So I think Peter, he might be 2 years too early for his plan. And I think he's had some people leave him, and which I don't think is a good idea. I think your money's going to be safer with Peter Schiff than anybody else, but than most anybody else. But he's really fighting, what could be a very deflationary trend. Which, if you think about it, makes a lot of sense. We've talked about credit creation, and of course that's all that's been happening in the last 10 years. The Fed and it's just been, and the government in general has been creating just a ton of credit. So usually what happens is that credit, people get overextended, the government gets overextended, everybody's overextended, and some of that credit is defaulted on, and it causes a deflationary kind of move in the market. So that's Germany. Japan, if you look at it, it looks a little stronger, but again, it looks a lot like our market. So we're seeing in Japan's case, they've closed the gap, which is interesting. And of course, as soon as it did, look, it just sold off. So, you could see Japan going down here pretty soon. So we've got a low, we've got a lower high. We have a higher low, but we also have a lower high here. So I would say, once we cross this area here, Japan's probably going to start accelerating to the downside. And all these markets are kind of linked, so you're going to see they're going to probably start moving in unison. They kind of already are. Here's the UK. Now the UK didn't close the gap. You see there's a gap here. And it's more sideways, so it might chop sideways and then rally up, close the gap, and then turn around, sell off. So these are just some of the subtle differences between the markets. Why am I not? There we go. All right, I think that's all I want to look at in those markets. Let's switch over to the other charts. And we've got up here is the euro US dollar, and you can see, kind of a move here and a sideways move and then another move down, and it's rallied here for the last year, a little over a year, and now it's chopping around a lot. And and I'll be honest with you, I've entered this a couple of times, to the downside, made a little money, lost a little money. I mean, it's just kind of, as you can see, there's no real clear direction here. So I think right now it's a 50-50 shot whether this thing is topped or if it's going to make one more high. I'll show you a chart in a second that potentially indicates it's going to make another high, which, it could come up here just above this and then sell off. Why don't I just show you that chart in a minute? Why don't I just show you right now? Let's just look at that right now. So this is my Ninja Trader. And you can see there's a trade setup here, a long trade setup up to this area. So these are the kind of trades I look for, where you can risk $155, but you have a chance to make $1,240. I mean, that's an 8x, reward to risk, which is really good. Let me close this for just a second. The thing that I'm looking at here, if I go to a daily chart, well, the daily's too much here. Let me go to an hourly. Yeah, well, that's even too much. Let's look at go back to the 120. All right, this is what I'm looking at right here. I guess 240 is the way to do it, which is a 4-hour chart. Yeah, so the reason there's a trade setup is because you can see there's an A, B, C. So this looks very ABC-ish. There's a possibility it could go down here and retest this DP area down here at the bottom. You can see that right there. So this trade could fail and come on down and make a lower low. But what it's looking at is it's looking at this first swing off the bottom. See, this is an important low. So you have the swing off the first swing off the bottom, a clear ABC. So if it breaks out above, this 1.23107, there's a good chance that we could get all the way back up here to 1.27210. So, on EWI, they're saying that the odds kind of favor that the euro is topped and the dollar is bottomed, but I'm not so sure. I mean, it looks like to me this could at least go up into this area around this decision point before it sells off, but we'll see. There's a lot of good trades in the forex market, and I like the forex because you can, as you can see, if you can trade up to like 20 something. Let me pull this over here so you can see. You can trade up to like 20 different instruments. These are the ones I trade the most, but you can see there's a lot of trade signals given here just on these 9 instruments, but you could trade like 30 instruments if you wanted. But let's just look at some of the others. Australia US dollar. Let's put it on a daily and look at everything on a daily. You can see we had kind of an ABC here, but then, so this is what I'm talking about. It made an ABC and then it gave you a trade setup. It ran up, but then look, it sold off and the trade setup failed. So the euro US dollar could be the same kind of situation. We'll just see. Even if it is, like I said, it should go up some here before it sells off. Let's see. The next one we have is the Euro Swiss franc. You can see it's kind of ran up, sold off, but looks like it wants to run up higher here. So Euro GBP. So that's just been sideways, really choppy. Euro JPY. Now this almost looks like the trend has changed and it's starting to head down. So probably make a new low, maybe get an ABC, and then that'll be a great trade to the downside. Here's the Euro US dollar again. Again, this looks, this second little move here looks very ABC-ish. So this could at least, like I said, I think there's a good chance that at least goes to here. So if you can see, if you'll notice, that's an ABC and then a down. So to me, there's an equal chance for the euro to top here, you know, for it to just continue downward, or to come up here and then go downward. And I wish I knew, but I have no idea what's going to happen. British pound US dollar, another good TS3 here. So, you know, an ABC kind of pullback. Looks like it wants to rally higher. If it's going to rally higher, it should rally into this area around 1.44. The US dollar Canadian dollar, this is the one that, you know, I was trying to get into a while back, and it's just really never pulled back. Now, one of the things you can see is you kind of see a 5-wave move. So once we've had a 5-wave move, you can see here, we typically get a pullback to the 4th wave low, which is right here. So maybe this is a good place to get in with a pullback here and here to the 4th wave low. And the trend, you know, if this is an uptrend, I mean, you can see here, if this is the first move up and this is the first pullback, then this is just the first move up of the larger wave 3. So this could be a very substantial move in the market, and it makes a lot of sense, because if US dollar CAD means the US dollar is in the numerator, so if we think the US dollar is going to go up, then US dollar CAD looks like it will go up quite a bit, which makes sense because oil is likely to start going down. We'll get to the oil chart in a minute, but I mean, there's a possibility if I put this on a weekly, you'll see that this could also be an ABC and then a sell-off here. But I don't think that's as likely, because this looks like an ABC here of larger degree. And we rallied pretty strong, pulled back to a higher low. So I think the move up here in the US dollar CAD is up. I would just wait for a little bit of a pullback, try to get in on this DP here on the daily chart. So again, if any of you guys are investing in currencies, one of the reasons I brought this up is because it looks like it could be going up for a while if the market does sell off and start going lower. US dollar Swiss franc, looks like it had a 5-wave move down here. It looks like we're getting an ABC. Then I would be looking for a 3rd wave pullback. If you make this into let's say a weekly chart, I don't know. It looks more like an ABC now. Let's try a 5-week. Sometimes you gotta try to figure out. Yeah, see here. I mean, this could be kind of an ABC X AB. So you might trade the US dollar Swiss franc might trade up into this area here, and then sell back off. But yeah, I would look for a pretty strong move. That's a good trade. I mean, you can make a lot of money trading that instrument to that point. Whoops. Let me go back down here and open up our chart. US dollar JPY. So you can see I've been looking at this one. Let's go back to the daily. Had a pretty good move down here. As you can tell, since I've got the Fibonacci retracement, I'm looking for some sort of retracement here. Also, there's a DP setup. Let me delete this. There's a DP setup there. So if I click on trade setup right here, It's not a huge move, but we're looking for a move back up in here to the fourth wave low. This would be the fourth wave low. You can kind of see here, this is probably an ABC with the C wave being a 1, 2, 3, 4, 5 kind of wave. So this Elliott stuff is it's not perfect, but it gives you a context for being either bullish or bearish on something. And that's what I like about it. But it's certainly not perfect. I mean, it can fool you as well. And that's just what the market does, right? It just fools us. All right, I wanted to show you, wanted to give you some context for what EWI is showing on the S&P and Dow. So what they're showing is that this move, you can see here's 1, 2, 3, 4, 5. And of course, as we showed, when we showed this earlier, we showed also that the VIX really took off. So you had a 5-wave move down and the VIX really spiking. And then you've had this really complex second wave, and then the first wave down of the next wave, which would be 3. So the way you look at this is the larger degree here, this parentheses 1, and then this other one without the parentheses is just the first wave of parentheses 3 that's going to go way down here. So, you know, the key to this is this high right here that was on March 12th. If we take out this March 12th high, then there's probably something else going on here. But if this market starts making its way down here, you better look out below, because this could go a long, long way. Certainly wipe out the last year, if not the last 2 years worth of gains in your account. So be very, very careful. I want to show you this one too. This is this you can see here. It shows the wave number 4. So they're saying we're in wave 4 of grand supercycle degree. So in other words, we've had 5 waves, which is the end of a third wave of grand supercycle. And after 5 waves, you get some sort of retracement. But check this out over here. They're showing below the target would be, these are Dow Jones numbers, by the way. The target would be below 3,000 points on the Dow Jones Industrial Average. I mean, do I need to remind you that the Dow Jones Industrial Average is at 25,000 points right now? So you were talking about a massive, massive, massive destruction of capital here. And, you know, it's not good. So, you know, the intermediate wave, the first wave down, this wave 3, they're saying could go below 18,000. I showed you, you know, below 2,000 on the S&P, and they're saying maybe even a little lower than that, maybe around 1750 on the S&P, or 18,000 on the Dow. So, and then let me just read this. It said the Dow Jones Industrial Average traced out the initial waves of a bear market from the 26,617 high on January 26. The intensity of selling pressure to the February 9th low was strong, and the next wave down, which started this week, should be even stronger. A new market reality is in place, but virtually no one thinks the current decline is anything other than a dip buying opportunity. And if you listen to TV news, you'll hear that. This sentiment will change, but it will be a slow process. The 3-month LIBOR rate has soared to its highest level in nearly 10 years. The LIBOR, by the way, is the London Interbank Overnight Rate, and that's kind of an important rate. A lot of your, you know, your line of credits and things like that are based on LIBOR. The swift rise in the benchmark used as the basis for many loan rates is compatible with the long-term bear market underway in bonds. It will eventually result in soaring yields across the breadth of bonds. Gold and silver declining near term. The U.S. dollar index started its largest advance over the past 13 months, and the euro declined over the same period. So he's taking a pretty strong stance that the dollar's bottomed and the euro's topped. Now another look. This is Deneric. This is a guy I look at sometimes. He does really good charting. This is your first 5 waves down, and then he's got this kind of complex ABC rising wedge, which I think is a good, I mean, potentially a good alternative to what Elliott has. In fact, if Elliott's charting, if this chart proves to be not accurate, then I would say this is most likely the one that's going to be accurate. Now, this is the Wilshire 5000, and he uses that because it's just a broader index and supposedly more, makes better waves. So, I would say, if we get a rally starting in the week, and then Wednesday after the Fed announcement it continues to rally, then we're probably looking at a scenario like this. But you can see he's not expecting this to make a new high. He's looking to fill this gap here probably and then roll over. Now we also have a gap up here, so this could spike intraday, and close that gap and then turn around and fall. So who knows? It's a huge retracement, but the way wave 2s work is they can retrace 100% of wave 1. It's perfectly within the rules. All right, so what to think about? Let's look at oil. Let's look at oil first. We haven't looked at oil. So oil, you got this huge ABC potentially, okay? But oil looks like maybe, the selling picked up in oil here, and looks like it's rallied a little bit. Could rally a little further, maybe to here, and then we should see oil start to make its way down to this area right in here. And then it'll bounce, and then make its way even lower. So the long-term prospects of oil, when I say long-term, I'm talking over the next 4 or 5 years, 3 to 4 years, is to have oil come down below this 25.91 area. So, I don't know, $20, something like that, but not less than 10. Because if you go back even further, which I'm not sure we can, yeah, you can. The low in oil, you can barely see it down here, is 1056. So we're not going to make a new low, but we could make a low. I would say this purple line is a good choice right here, around $17 to $15. So if you're thinking about investing in oil, like I said, it's your money. You can do what you want, but I think oil, we should start seeing oil turn lower. It might, for the next week or two, rally a little bit, but then turn lower. I would say within the next month, we're going to see oil turn lower. All right, let's look at gold. We had all these different options for gold, and bottom line is it looks like it's taking the first one here, although instead of just going straight down from here, it rallied and now it's going down. But it didn't make a higher high, or if it did, it was just slightly higher. And I would look for gold to go down into this 1170 area before bouncing. Now, and when I say bouncing, it may only bounce a little bit and then sell off. Now, I think silver is a little bit more complicated. You can see, looks like silver's got this. Let's see if I can move this up. It's got this kind of an A, B, and then it's got this more complicated pattern. But you can kind of see like an A, B, C, D, E. And if that's E, then this would be the first move down. Let me zoom in on this. If this is E right here, then this move right here would be the first move down, and then we would have some sort of retracement, a little higher numbers right there, and then you'd see silver start to make its way lower. So where's the bigger picture on silver? Somewhere below this 1213 area. If you really look at the real big picture, to me, and I don't know, this chart almost doesn't make sense. It looks like to me silver really should go up here around 30 and then sell off to a low down here around 7.5. But we talked about this before, and this is one of the reasons I was saying, don't get greedy and try to wait for silver to be here, because it might not go here. It might just kind of go up to here and then back down to here and then rally and never see these numbers again. So that's the risk you run. Something gets away from you and you never get another chance to get back in it. Hopefully that doesn't happen to anybody, listening to this program or watching this program. That's really about it. So let's go back to the S&P 500, which is here. I'll tell you what, let's look at the Dow, because everybody's really following the Dow. And we should probably do the same thing here, although I don't have anything really drawn on the Dow. But here's the Dow. Here's the February 16th low. Here's the run-up. This is about where Trump got elected, right in here. Yeah, right here. So this is all Trump. And he's taking credit for this thing. I mean, he's gonna regret taking credit for this market. But one of the things you can notice here is the volume increase here. So as we were falling, the volume really spiked, and then as it rose, the volume fell here, and then the market fell, and look what the volume did. It went up. So when the market falls. When the market falls and you have high volume, and then it rallies on lower volume, and then falls again on higher volume, and then lower volume again on the rally, that's usually not good. Okay, so I would say in general, the bias for this program is to the downside, just like EWI shows it and just like Deneric shows it. But there are times when volume can mislead you. There's no 100%, way to look at the market. You just have to constantly. I used to have an instructor who said trading in the market is a decision-making process. So the market does something and you make a decision. The market does something else, you make another decision. The market does something else, you make another decision, and you just continue to make decisions based on what the market shows you. Predicting the market is very difficult. If you've been watching this for any time, you know that that's true. So even when there's a clear pattern, it doesn't necessarily mean that the market's going to follow that pattern. So, but you can start to see, you can see the moving average is starting to kind of roll over here. We rallied up into the moving average, came down, rallied back up into the moving average, came down, rallied back up into the moving average, but you can see it's lower each time. And, who knows, next week we might have a candle that looks like this, and then the week after that, one that looks like this. And then at some point we're going to get one that looks like that. So that's kind of the way the market works. So that's why you have to kind of pick a place. And maybe what you do is you just say, look, I'm going to draw a line like this, and once I get a close below this line, I'm out, and that's it, But if you did that, then what would happen is if it went the other way, and kind of did this, and then did this, and then did this, you'd still be in. Okay, so you just have to kind of pick a spot and say, that's it, that's all I'm willing to lose. And I think if you do that, you'll be safe, and you'll be happier, you'll sleep better at night, and in general, you won't lose all your money. So. All right, everybody, that is it for this week. Feel free to comment in the comments section on the video. Feel free to copy the link and send it to your friends and family. I think there's a lot of risk in this market, a lot of risk. I mean, when a company like EWI is publishing for the whole world to see that the intermediate target. So intermediate, just to kind of give you an idea, what is intermediate? What's an intermediate trend? This right here from here to here is an intermediate trend. So that's a 2-year trend, okay? So even on the intermediate trend, we're talking about 18,000. That is a significant, I don't have a calculator handy right now, but that's a significant loss of capital, okay? And then the longer term risk is below 3,000. That is a tremendous loss of capital. Actually, before we go today, I'll tell you what I'm going to do. I'm going to show you something else that EWI published, because I think it's very interesting. So this guy Robert Proctor, really studies the market carefully, and I won't bore you with this whole write-up, but I just want to show you potentially what some of these the market direction could look like for as much as the next 100 years, okay? First of all, he does this whole study. This is all 1929 data, and then this is 1987 data here, and he shows what happened. And then this right here is present day data. So you can kind of see these all kind of follow the same pattern, you know, and that's what he's pointing to. So the other thing he shows, oh, it's not on this one. This is the interim. Let me pull up the yeah, that's the interim. Let me pull up, sorry about that. Let me pull up this one, March 1st. So he goes into all this. There's a lot of theory behind all this, but let me just show you something. This is the part I want to show you. So here we are right here. Today we're right here at this line. He's saying this wave A could take us, this area right here, this 3 and 4 area right here is the 1974 lows. So this is 1968 to 74. So he's talking about this wave A coming all the way back here to 1974. I mean, that is a tremendous loss of capital, okay? And then this sideways move could last, you know, he's talking about different, you know, the reason these are different heights and stuff is because he's talking about a flat versus a triangle. Like this is a flat here, but I think it's more likely we have some sort of triangle. But he's showing the different heights because it could vary a certain amount, because these are dollars. This isn't gold, okay? And dollars can be manipulated by the government, so you have to allow for a little movement due to inflation and things like that. But he's saying this triangle, this A, B, C, D, E triangle for wave 4 could last somewhere between 64 years and 200 years, which is amazing. So it's a really interesting write-up and discussion of theory. This right back here is the South Sea bubble. So we had this run-up in the South Sea bubble. This sell-off took 64 years right in here, this ABC pattern. And then this wave 1 was the run-up into the 1929 crash. I'm sorry, that's not right. This whole area, this whole run-up here into this wave 3 was this is the 1929 crash right here. And then this has been ever since. So 1932 to present is all right here. So we're gonna experience some large sell-off. It's hard to say exactly what it is, but if he's right, and I think there's a good chance that he is, I mean, we could be going, you know, at least back to the 1987 lows and potentially even further. So with that bit of good news, I think I'll go ahead and sign off, and you guys keep coming in. I think it's going to be interesting here the next couple months, and probably have a lot to talk about. We'll talk about some of what the popular culture is talking about as this starts to unfold, and the political comments around it, and so on and so forth. The Fed, I think, is going to come under a lot of pressure. It's just going to be really interesting times. And, you know, if we're safely on the sidelines, it won't be so stressful for us. All right, everybody. Thanks for coming in. We'll see you next week. Bye-bye.